COMEX currently holds roughly 102 million ounces of registered silver available for delivery. Against that, open interest tied to March contracts represents more than 400 million ounces. Even if only 25% of those contracts stand for delivery, the exchange would require over 100 million additional ounces beyond what is currently registered. At 50-70% participation, the shortfall balloons to 200-300 million ounces against inventory that is already declining. That mismatch between paper obligation and deliverable metal is the core tension in this market right now, and it is unfolding while Shanghai silver stocks have fallen to 10-year lows. To understand how we got here, you have to look at what happened during the final week of January. Silver prices were aggressively sold, with gold falling 21% and silver collapsing 47%. Yet the total trading volume during that single week reached 1,204,394 contracts, the equivalent of 6.02 billion ounces of silver. That represents more than 7 years of global silver production traded in just 5 sessions. There is no other commodity market on the planet that absorbs that scale of synthetic selling pressure in 1 week. Despite that extraordinary volume, the broader technical structure did not break in a way that suggests long-term failure. In fact, gold marked a higher low while silver printed a marginally lower low, creating a bullish divergence that is often seen near intermediate bottoms. When silver broke out of a year-long rising channel in December 2025 and accelerated into a parabolic advance, it appeared extended. The subsequent collapse in January looked violent, but price returned almost precisely to retest the upper boundary of that same rising channel. That retest held. Markets do not often return with such geometric precision unless structural support exists beneath them. For that reason, it is reasonable to argue that the correction is either complete or largely complete, even if a final retest occurs during the next few sessions. Silver has a long history of revisiting breakout levels before launching into its next advance. The gold-to-silver ratio reinforces this view. Following the breakdown in November 2025, the ratio collapsed from 77 to 43 in less than 2 months. During the recent pullback, it retraced toward the previously broken 2021 to 2024 horizontal region near 73 and appears to have successfully retested that level. If the breakdown remains intact, the ratio's next major target lies in the 2030 range, potentially by late spring or early summer. Historically, when the ratio compresses into that zone, silver does not rise gradually. It accelerates disproportionately relative to gold. That is the analytical basis behind projections of $200, $300, or even $500 silver. Those figures are not derived from emotion. They are derived from ratio compression mathematics combined with volatility expansion. Michael Oliver recently suggested that gold could approach $8,500 in 2026 and that silver could reach $300, $500 within the year. Whether or not those precise numbers are achieved, the directional logic aligns with the structural setup. Silver is persistently underestimated because of its nominal price. That psychological discounting is exactly what allows it to overshoot during late cycle moves. What many analysts are misreading is the phase of the bull market we are currently in. The wall of worry phase, characterized by drawn-out consolidations and steady skepticism, appears to have ended when gold and miners broke structural suppression and when silver cleared $50 decisively. We are likely operating inside the final parabolic phase of a 26-year bull market. In parabolic phases, volatility expands by 40-60% following breakouts, consolidations compress into shorter timeframes, and pullbacks frequently resolve in V-shaped recoveries rather than slow-base formations. This dynamic is amplified by modern behavioral patterns. Investors today operate in an environment of instant feedback and low patience for prolonged range-bound conditions, which contributes to more extreme price swings. Unlike 2011, today's cycle is occurring amid documented physical strain. COMEX delivered 63.88 million ounces in December 2025, followed by 49.40 million in January, more than 7 times January 2024 levels, and roughly 20 million ounces during the first week of February alone, including a single-day draw of approximately 3.5 million ounces. February's delivery rate has reached 98%, and inventory is draining at an estimated pace of 785,000 ounces per day. Registered silver stands near 102 million ounces, while open interest exceeds 400 million. Even modest delivery participation produces structural pressure that cannot be dismissed as routine. At the same time, global exchange inventories outside the United States are thinning. Reports indicate that Shanghai and other Asian vault systems are heavily drawn down, and anecdotal evidence suggests aggressive physical buying. Over weekends, additional data has emerged pointing to continued shortages of physical silver in key markets. When banks must source metal to meet delivery obligations, price adjustments often follow. There are, of course, counter-arguments centered on industrial demand. Solar accounts for roughly 20% of global silver consumption, and at prices above $200 per ounce, certain applications would become economically unviable. Thrifting. The process of reducing silver usage or substituting with copper is already underway. EV credits have been removed in several regions, EV sales are slowing, and solar incentives have been reduced, leading to layoffs among installers and manufacturing adjustments. Demand destruction would not occur overnight. It would phase in gradually. However, even with potential substitution, the broader structural reality remains. Unlike gold, which has largely been preserved throughout history, silver has been consumed in industrial processes. Current reserve estimates suggest less than 20 years of economically mineable silver at present extraction rates, and new supply additions are limited. If even 25% of March open interest demands delivery, COMEX would require more than 107 million ounces beyond current registered stock. At 50-70% participation, required metal rises into the 200 and 300 million ounce range against inventories fluctuating between 85 and 103 million ounces. That imbalance does not guarantee immediate price spikes, but it establishes fragility. Once clearing pressures subside and books are balanced, any incremental demand shock can produce outsized price reactions. Overlaying this metal setup is an emerging macro signal. JP Chase, the largest U.S. bank with over $4.5 trillion in assets, is tracing what technicians identify as an ascending broadening pattern. Such structures often reflect internal instability beneath outward expansion. As the fifth reference point matures, complacency becomes dangerous. When large financial institutions display widening volatility patterns while precious metals compress structurally, it suggests that underlying monetary tensions are building. This cycle increasingly resembles a compressed version of the 1970s. In 1974, gold corrected violently before launching into the 1979 surge. While time frames today may be condensed into months rather than years, the structural analog is worth noting. If silver reclaims the $120 region by late February or mid-March, it would signal that the correction has resolved and that the next leg of the advance is underway. For now, the evidence suggests that the correction is over or very close to over. The retest of the rising channel has held. The gold-to-silver ratio breakdown remains intact. Delivery stress continues. Exchange inventories are thin. Volatility expansion is consistent with a late-stage bull phase rather than a top formation. It would not take much additional strength, a handful of sustained sessions to confirm that this market has transitioned from correction to continuation. As always, this is not financial advice. Market data should be independently verified, and volatility at this stage can be extreme. However, from a structural standpoint, silver is not behaving like a market that has peaked. It is behaving like one that absorbed a historic shock and is preparing for its next major move.